The months-long banking crisis claimed another institution yesterday when First Republic Bank was seized by regulators and sold to J.P. Morgan Chase, the second largest bank collapse in U.S. history. As with the other bank failures this year, First Republic's assets were battered by rising interest rates enacted by the Federal Reserve in response to continued inflation, as well as potential mismanagement by the bank itself. This latest downfall has weary depositors and investors asking what to expect in the coming months. Joining me now to discuss it is Joel Griffith. He's a research fellow in the Thomas A. Rowe Institute for Economic Policy Studies at the Heritage Foundation. Joel, welcome to Washington Watch.
Thanks for having me tonight, Joseph.
It's good to have you. Tell us a bit about what happened with First Republic Bank.
Well, what happened with First Republic is very similar to what happened with PBNY and SVB over the last few months. We saw these banks, they took in trillions of dollars of new deposits over the past 2 years from all the trillions of dollars that were printed. And they parked a lot of those investments in things like government bonds. Well, what happens to the value of a government bond when interest rates go up? Well, the value of the bond actually goes down. And that's also really a reflection of the fact that investors are realizing that when they're buying these promises from the government to repay the debt, they're realizing that those dollars are going to be worth a lot less going forward because of inflation. And so those banks, when it came down to it, they saw a lot of their assets diminish in value. And as depositors started catching on to that and requesting that the bank give them their deposits back, people began to realize that there was just no way this bank would be able to honor all of those deposits. The deposits exceeded the amount of assets the bank actually had, and that is why that bank as well has now gone under.
Now, Joel, if it's true that government policy is crushing the value of the assets of these banks, why aren't we seeing more of this happen?
Well, the panic thus far has been contained. And indeed, when it comes to these different banks, there are different concentrations at every bank in these different investment classes. First Republic, SVB, and Signature Bank, those were the three of the banks with the highest amount of concentrations in that government debt. And what banks typically try to do, if they're being smart, they'll match the deposits with shorter term investments. What you've seen right now, when you have banks putting so many of these deposit dollars in longer term assets, those are very sensitive to interest rate fluctuations. And unfortunately, a lot of our so-called experts in this country were not predicting that we would have such rampant inflation, and thus they weren't predicting that the Federal Reserve would react in kind. Now, a lot of free market economists, such as myself, were warning over the past few years that if you have government spending out of control and you rely on a central bank to print new dollars, eventually you're going to have a big problem. And that big problem is called inflation. And that's what's happening now. But, a lot of politicians, both Republicans and Democrats, they still are refusing to actually address this risk going forward.
Now, Joel, J.P. Morgan Chase is going to pay $10.6 billion for Republic Bank's assets. However, the FDIC is giving $13 billion to J.P. Morgan Chase. To do this, explain why this makes sense.
All right. So when you have a bank, you have assets, which are things like the loans that a bank makes or investments such as real estate or government bonds. And then you have liabilities. Liabilities are actually the deposits, what the banks own us as depositors. Well, in this instance, JP Morgan is going to go ahead and take and retain those deposits because it's going to retain the assets. And yet the government is going to pay 80% of the losses if they materialize. And if that strikes you as quite odd or unfair, well, it's because it is very unusual and it is very unfair. In effect, we're socializing the losses and privatizing the gains. And JP Morgan themselves have said now that they anticipate several $billion worth of additional income over the next several years, thanks to this sweetheart deal that they got paid for by all of us, the taxpayers.
Well, I do sit here wishing that the federal government had given me the opportunity to take over this bank under those terms, because that would be indeed life-changing, and there's not many of us who would turn that deal down. A very low-risk proposition. But Very quickly, White House Secretary Karine Jean-Pierre was asked by a reporter about the optimism that President Biden has expressed earlier in the day about the banking system. Here's what she said. Let's play clip 6.
We have taken decisive and forceful actions these past several weeks to make sure that the banking system is in a stable position, and that's what you've seen this administration.
So is the banking system in a stable position, Joel?
No, in fact, I challenge any of the viewers watching now, go look up ticker symbol KRE. KRE is basically the index of all of the regional banks across this country. That index was down another 5+ percentage points today. It's down, I believe, more than 30% over the last few months. And that's because investors are realizing that our smaller banks are not doing so well. The guys at the top, like JP Morgan, they're going to continue to be able to gobble up these smaller banks that go under. But these smaller banks are in big shape or bad shape. And part of the reason why is you have bailouts for some, no bailouts for others. It seems that the regulators are making things up as they go. And let's not forget, too, when we think about these big banks that went under, the Biden administration keeps claiming there were no bailouts, but there were bailouts. Investors know, depositors know that only the first $250,000 of deposits are actually insured. And that basic insurance stops at $250,000 because we understand that you should have depositors making sure, when they're wealthy especially, that the banks are actually on solid footing. We were taking away that moral hazard. And in all these banks that have gone under, we've actually made whole all of the depositors. Even the billionaires have been made whole in this, and that's come at our expense, regular middle-class taxpayers.
Joel, in about 30 seconds, have we seen the end of this, or is there more where this came from?
Unfortunately, there's likely more where this is coming from, and that's because we're just beginning to see the impact of the softening real estate market. A lot of banks have made trillions of dollars worth of loans in the commercial real estate, not just home mortgages, and commercial real estate prices are actually plunging right now, meaning that those loans are probably not worth nearly as much as these banks were anticipating.
Joel Griffith, Thomas Arow Institute for Economic Policy Studies at the Heritage Foundation. Thanks so much for your time today.
Thank you.